Hey, Dan Passarelli here. Let's talk preparation. Today, the market continued its route lower, the route that it's been on for the past 3 weeks, closing for the second time under the 200-day moving average and getting within a few cents away from official correction territory. Correction, of course, being when the market's down 10%. I mentioned that yesterday. But there's a couple things I didn't mention yesterday. One is, does it really matter if it's officially a correction or not? Maybe because of the psychological aspect of how investors and traders think about the market. It could have a psychological impact that could have some carry through. But in reality, it really doesn't. So when we get down to about this level, when we get into correction territory, it typically takes on average about 4 months to recover, but that's on average. There's a kind of stereotypical thing when it comes to trading, a trading idiom that goes something like this. It's different this time, which is always a fallacy. But that said, we have to consider what's going on and why it's going on. So we've been in these negotiations. Our government, Trump, has been in negotiations with Canada and Mexico. And today's headlines really focused a lot on Canada with their retaliating and then backing off on energy. The stated objective for these tariffs is to basically work out deals with Canada and Mexico. And you may or you may not agree with how the negotiation is being handled. Sounds to me, from what I read, many people don't agree with how they're being handled, but that's what the objective is. So one thing we have to be prepared for, whether we think it'll happen or not, because when we're in trading and investing, we have to prepare for things that we think will happen and things that we don't think will happen. Well, we do have to prepare for what if the negotiations work? What if Canada and the US agree on lowering tariffs across the board, more free trade, and that deal ends up being announced tomorrow, the next day, next week, next month, whenever it is? Well, what could and I think would happen then is the market would rebound very, very, very sharply. It wouldn't be a 4-month thing, in my opinion. And so folks who typically in a market like this might be selling call credit spreads and aggressively going short, I urge a word of caution. And I'm not predicting the future. I'm not calling the bottom, but it is something that we do have to and want to be prepared for. And so we should choose our positions accordingly. Limited risk if we're going short, and picking spots and being cautious for going long, all the while minding the volatility levels and constructing the optimal positions that take advantage of high implied volatility. Hope that helps. This is Dan Passarelli, Trade Smart.